Mic check and screen share check, please. My soundtrack for today. This is a nightly strategy podcast for, August 19th, 2022. So we'll get started with the another form of the market health check. So this one is the, I'm going to start adding this one to the weekly, the regression line fractal framework. Just a quick lesson on how to read this thing. So this is the S&P on a daily chart, and there's four regression lines in here. There's the 270, the 90, the 30, and the 10. So the 270 is this rascal right here, the pink one, which is getting ready to roll up. That we treat that as the long-term buy and hold fair value. So that's folks that are holding for the long term, and what they think of as the fair value. That's our proxy. The shortest term one is the RL10, which is in the blue, and that's the trader's price. Trader's price. And so when there are so the RL270 is the slowest of the slow pair. The slow pair is the 90-270. The fast pair is the 30 and the 10. The 30 and the 10 is the basis of our RLCO framework. So the 10 is fast and the 30 is slow, and that's the fast pair. In the 90-270, the 90 is the fast, and the 270 is the slow, and that's the slow pair. Now this 90-30 is the intermediate pair, in which the 30 is the fast and the 90 is the slow. And you see that there is a factor of 3 in this fractal framework. So the fast RL10 times 3 gives you the slow RL30. And the 30 times 3 gives you the 90, and the 90 times 3 gives you the 270. So there is a ratio relationship between each of these pairs. So when you're looking at the 10-30, like we see right here, this is like a P1, where the RL10 crosses the RL30. If we went up to a 3-day or a weekly, you would see the 10 and the 30 there on the higher time frame is the same as the 30-90 on this one. So when I see the 30 cross the 90, that's where the 10-30 crossover would look on a 3-day chart, because that's 3 times longer. And you're going to notice that those crossovers or failure to crossover are really significant. Like here's where the 30 crossed to the downside, and that led to this move. And when this crossed over, that was sort of a signal to go here. So you might want to pay attention to that 30-90 crossover. I'm just saying. That's like a nice confirmation of a trend. And so the 90-270 would be the same as a 10-30 crossover on 2 time frames higher, on like let's call it a 10-day chart or a 9-day chart to be accurate. So when you see the 90-270, that's the beginning of a trend this way, and we're just getting ready to change that trend back to the long term. If this energy can keep going, that's going to pull the 90 across the 270 in about a week, And then, in theory, that's going to make that a thing of the past, that we will have emerged from that pain and suffering. So that's how the 1030, the 3090, and the 9270 work. Now, the interesting feature of the regression line fractal framework is if we take the fast of the fast, the 10, as the trader's price, and we compare that to the slowest of the slow, the 270, the long-term buy and hold, we get a real difference of opinion between the 270 and the 10. This is the most conservative buy and holders and the fastest, nervousest traders. So there are times when the RL10 is equal to the 270. Oh, by the way, this is a super pinch. All the regression lines are right there in that little nugget of a possible turning point. Yeah. Well, the first thing that's a moment when both of these market participants, the fastest of the fast and the slowest of the slow, both agree that this is the fair price. Both of them. That's either going to stay the fair price forever, or the traders are going to make a move. Now, how strong are the traders? How much power do they have to move price away from the consensus long-term fair value? Well, in this case, they could move it that far. So it began to diverge, and that's as far as they could get it until they couldn't get it any further, and it started to reverse. That's why we pay attention to those turning points in the RL10, because that is the smooth price. That's really the statistical price where the traders couldn't push it any further. So we could actually say that the strength of the traders was to move it that far. Now, if they can't take it any farther, what's most likely to happen? Something like a reversion to the mean. There will be some kind of recovery where now the bears have had their run, and that's as strong as they could be, and now the buyers come in and buy this quality merchandise on sale, and that represents buying pressure. And it's moving back towards the 270. In the time that the traders were able to take it down to this price level, it only made the 270 drop that much because of math. So we can actually start thinking now that the distance from the turning point back to the RL270 would be the least surprising move, and we might be able to frame that in terms of standard units of reward and risk, and then determine that if I'm going to have this much risk, I might be able to say 1, 2, 3, 4, 5, 6, and that justifies this trade. And then when it can't roll over anymore, notice that the dragon acts as a buffer, and when the dragon can't hold it, that thing fails. So watching the RL10 with respect to the edge of the dragon is significant. So as this starts marching up, we notice that the RL270 is slowly decaying, so not as fast as this moves up. So there's always some kind of projection that in the time that it takes to go that far, this thing will come down, so you get some idea of a convergence over in here, if the impulse is going to follow all the way through. So in the regression line fractal framework, we look at the distance that price moves with respect to the RL270. Notice that even here, this went a little bit lower, but then the price was a little lower. That's about how much power the traders have to move this thing to an exaggerated distance in one push. That's how much power they have. This was an extraordinary move. That was like a double scoop. That's how painful that was. Now, when the RL10 comes back to the 270, we can say, hey, that entire series of excursions is over. And now, how far above the 270 can price push. Well, we might take one of these markers here and say, I can go about that far. And so it's en route. So we would not be surprised if this impulse could get it back to about 450. But if it fails here, then that's how strong they were able to make it. To go from this far down, leg 1, back to the 270, and then leg 2 up into here. So we can start calibrating the power of traders to move away from price and then start computing the reversion to the mean on the basis of, standard risk boxes. Maybe those are ATRs. Good idea. So we can use the 10-270. We can use the 10-30 to look for those crossovers. I really like the 30-90 crossovers because those are a little bit smoother and give you some clear sense of direction. Like when all these shenanigans are over, the RL30 rolls up. And this is the basis of owl trading, by the way, is that when the owl happens, it's because there was a move that broke down and then the RL10 crosses the RL30. And then you get an SSC in here. But you don't get an owl until the RL30 rolls up. The RL30 and the dragon both have to roll up after that harsh sell-off. And that extra confirmation is what makes the owl interesting, a little more conservative, demands a little more evidence, whereas the SSC is quick, fast, and in a hurry to get in. The owl is a little slower, a little wiser, and waits for the dragon to turn and the RL30 to turn. So here's where the dragon turned. So it was still price was still a little choppy, but this is where the RL30 turned and then crossed the 90 right after, and that's sort of confirmation that the move is happening. And now look how good that move in the owl is. So there's reasons why you're interested in the owl turning, the owl trade. And when the owl turns over, that's telling you the trend is down. So looking at the turning points in the 30 now become interesting ways to gauge the health of the trend. So in the RLFF strategy, we say that the RL10 is the trader's price. The RL30 gives us the health of the trend. So we're looking at its slope. When that RL30 rolls over, the health of the trend is weak and it's down. And when the RL30 rolls up, that trend is getting healthier. So the slope of the RL30 matters. The 90 is the health of the trend of, I can't draw the line, health of trend on the higher time frame. So the next higher set, and then the 270 for us is the long-term buy and hold fair value. So on the basis of that, without even, I've turned off the price. If you look very closely, you can see I've made price a very, very faint gray line. But really, in this kind of swing trading style, all you need really is the smooth price, which is what the RL10 gives you very nicely. And then these other regression lines, like the 30 confirms turning points, the RL90 confirms turning points on higher headquarters, and then the RL270 acts as sort of like a baseline of long-term fair value that we get excursions away from and then reversions back towards. And again, because of symmetry, the strength of the traders to move it this way is how we project the potential for moves on the other side. You get overshooting each time, so you get this kind of oscillation around that smooth 270. Now the final thing that you'll notice is this gray ribbon right here. So that is a Bollinger Band 30 on the RL270. So this acts like a buffer. When this price crosses the 270, I don't just automatically flip my switch. I just recognize that the width of that Bollinger Band, which is a lagging indicator, is sort of the zone in which the noise on the far side that it has to penetrate, and you think, it's really going. So this last little move is showing some potential strength in that sense. What's very interesting about that is it gives you a real sense of where the turning points are, because when the RL270 goes up, you'll see that the gray ball, the ribbon gets very fat the further that goes up. But when the 270 rolls over, starts to get thin, that this ribbon starts getting very, very thin when the price flattens out. And you see that in here. And then this little point here where the RL270 was on the north side of the ribbon and then crosses to the downside, now you can start seeing that ribbon getting fatter and fatter as the trend is going down. And that acts like a noise buffer. So just some the beauty of math when it comes to that. So this is a very handy way to rapidly view what's going on multiple time frames. Now here's the pro tip. I just happen to be showing this on daily bars, but you can put this on 1 minute bars and the interpretation is exactly the same. And on intraday trades, you can actually play the move from the RL10 turn back to the RL270 in terms of the R10 risk boxes that we use. That's magic. Anyway, this is called the RLFF strategy. Why is it a strategy? Because it is a general purpose set of rules and schemes that allow us to interpret what's going on and give us a unified plan of action in many different circumstances. What do you do when everything is tightly bunched? What do you do after an excursion when it's coming back to the checkpoint? If it doesn't break through, that's not surprising. In the same way here, failure to follow through, that's not surprising. And now you can see how the dragon acts as a little buffer that once this rolls over and the dragon can't stop it, then it's a runaway freight train. But here, the dragon is providing support, and now it rolls up. So we can start using this strategy to start framing trades in standard ways on multiple time frames. And the beauty is that we interpret the information the same way from those indicators. Same interpretation if this was 1 minute or if it's weekly or daily bars. Doesn't matter. So here's our 150 look back. Now we're looking at the standard structured sniper approach. And briefly, here's our 1 day box, the 5 day box, the 10-day look back, the 30-day look back, and then more sets of 30-day chunks all the way back to the 150. And now that gives us all the operational information from the sniper, which cares about the 150-day look back. And where are we inside the 150-day look back? If this is 100 and that is 0, price in here is right around the 50-yard line, so 0.5. On the 30-day look back, if that was equal to 100 and that's equal to 0, this is right around the 0.8 or 0.85. On the 150, that's about at this 50-yard line. And then on the 10-day, that's back to about the 50. So you can see that it's at the 50-yard line on the 150 and the 10-day look. But the 30-day is pretty healthy because it has all this trend. But the 10-day is starting to be a little weak. It's the low, it's the high, but it's already come back to about the middle of that 10-day box, which makes it interesting because now a breakout from here can come up and challenge the 10-day and the 30-day high. And if it gets through there, Then we're looking at this price level, which is geared to that resistance. And if it breaks through there to this level, which is the peak of the RL10 over here. So these are resistance levels that become price targets on the way up. And every time it gets through that successfully, then you start thinking there's energy for it to run up to the next target. So this gives us a way to frame price ladders on the way up to allow us to do structured reward to risk ratio. Same thing on the way down. Here's the 5-day low, 10-day low. Here's an RL10. This used to be resistance and now is support, and it also happens to be support with the PSAR. So that right around 419 is really crucial support, because if that breaks, then that entire PSAR trend to the upside gets broken. So this is really, really crucial territory. And if that fails, we're back into this, because today this was enough of a pullback to take us from sideways quiet down into bear quiet. So it just got a little bit worse from sideways to bear on the basis of that little pullback. So caution is there. It doesn't take much for a quiet bull to be a bear to be very hungry after this long slumber. And look at when that bear wakes up and starts to get enraged, that's what happens to volatility. It gets bad in a hurry. Whereas it takes a long time to have the bravery to march up the hill while the bear is sleeping. When that bear wakes up, look out below. So we're just mindful of that. Here is the zoom in on the 30-day now. So now we've taken that same frame and looked at the 5-day, 10-day, here's 20, and 30-day look back. So there's the 30-day high. Here's the 30-day low. That gives us this bracket. And so you can see price is pretty much near the top of that. So if this was a thermometer and this was all filled in, there's only that little bit here. So this is about like 0.85. That's pretty healthy on the 30-day. Again, on the 10-day, though, that's 100. And this is 0. So that price on the 10-day is now about 0.5. So the 30-day look back is actually pretty healthy, but on a 10-day look back, this is already feeling, back in the middle and a neutral orientation. So this was definitely some weakening action. Now the good news is that 1-day price range, this bar here, was not very large. And the 5-day range is small compared to the 10-day range. But we're coming up right into this crucial support level here, right around, call it 420, 419. This is really crucial support. If it holds here and then gets above the RL10, then everything is happy, happy, joy, joy, and then it has to get through that resistance. But if this were to fail here, then we're setting targets looking for this, and then if that fails, then it comes down to here. Ooh. Then it starts getting ugly in a hurry. So remember, bear quiet can get bad in a hurry. Now, if we look at the 30 minute, now we've zoomed into the day, right? Here's this is our 5-day box, 2, 3, 4, 5. So there's now our 5-day, and here's our 10-day, and all the lines still mean the same things. So today was a gap down, quick sell-off, and then it never really got out of the hole. It didn't fail further, but it was trying. That is not healthy. So this whole support level right here should hold. Last time it was there, it made a nice run up. But if this fails, you can see that there's this target. And if that fails, it gets back down into this level. And if the 10-day low breaks, look out below. So we've got a very interesting range compression, zero state, strong move in either direction is possible. We love that for framing trades in both directions without a directional bias. All right, so we're looking at our tactical symbols now. We'll start with the market and the big six indexes. So here's the S&P today. It lost 1.34%. The Dow was the best. It only lost 1%. Emerging markets were a little worse at 1.36. Treasuries were off 1.6 to close at 113. It's coming into the buying zone. The Qs lost almost 2%. The Russell was the worst at minus 2.15. So here's our two little speculative ones that gave up the most. These were the ones that were the strongest in the last 30 days, dragging the market northward. But they didn't have it today, and nobody wanted to hold it over the weekend. And then Tesla, our little bellwether, was off 2%. Couldn't hold 900. It's still at 890, but it broke through the crucial psychological level of 900. The range stat is still $50. The R10 is, $5 on Tesla. All right. So let's take a look at the where was the weakness today, starting with the sectors. Again, it's always anchoring to our baseline of the market at minus 1.34. Oil exploration 1.4, then a cluster of biotech, tech, materials, and wheat and precious metals 1.8 to 1.9. Finance and Simon Property Group 2%. Discretionary 2.1. Then Brazil, the FANGs, and marijuana up to minus 2.2. Lithium minus 3.75. ARC Genomics 4.5. Clean energy got smoked 5.6. ARC Innovation and Blockchain 6 and 6.25. Now all of the cryptos and the financial disruptors. Global Future of Finance 8.5. Blended large cap crypto 9. Bitcoin 9%. Ethereum 11%. So this was a rejection of those. Now, individual targets. Coinbase 11%. Robinhood 9%. Squarespace 6.75. Even PayPal 3.3. So all of the financial disruptors getting smoked. Now, let's see. Alcoa 5.25. Cliff 3.5. U.S. Steel 2.25. So here was the case where once again all our metals were moving in tandem, and they had a couple strong days this week, but now all of that gave back. So they tend to be very cyclic and moving in tandem. So when we get large sell-offs or large gains, we like to see turning points and then try to play the directional changes intraday. So the metals were weak. And they were weaker than their ETF counterpart there in material. So when the metals are weaker than the ETF, that's a sign that you want to be in them on the short side, if I can say it that way. All right. Let's take a look at the... I should also say while we're looking at the downsides. Microsoft and Apple underperformed the S&P, although they were better than S&P Tech and the Q. So that was actually a store of value, that they were actually, when they're better than the sector, that just reinforces the notion that that is more like a conservative store of value, whereas some of the other tech plays were much worse. All right, to the upside. Again, we start with the S&P, our bellwether. That's minus 1.34. And now these are all sectors with the exception of Devon Energy, which was up 0.87. Lumber, the two lumbers off 0.75 and 0.9. Residential real estate, Mexico, Aussie dollars, staples, oil, blended commodity. Now we're getting into basically flat. Energy sector was flat. VIX was up just a fraction, so there's no panic quite yet, but it's starting to get a whiff. And then agriculture up 1% to close above 20. Notice that the R10 on that is only 3 cents. Amazing. It doesn't move much during the day, but it tends to be tradable on swings. So that's our snapshot there. I'm going to finish out with the sniper trades of the day so we can kind of dispose of the daily before we look into the next week, okay, and bring this week to a closure. So Devon Energy was the sniper trade today. This was the here was the OR3. Here was the breakout. Standard risk box. It went up and then sold off quick, hit the PSAR. So that's a standard exit, minus 0.5. I was only interested in the long side because energy was the strongest sector by far. It gives me a RL10 reversal, PSAR flip. So we buy the breakthrough of the PSAR, standard risk box. If this gets above the RL10, then this becomes interesting. Standard exit. Standard re-entry on the reverse higher. This is now a COTA 2. Standard risk. Standard exit. COTA 2. You could feel that one coming. Basically a scratch. That's the consequence of not playing the short side on that one. There were 2 legs down on a tradable short, but my bias to the upside, had the following consequences. It kept me from getting jerked around inside here and in here, but I missed those 2, and I'm happy to just play the long side on the strongest stock in the strongest sector and get paid on those, right? So that's one of the trade-off decisions that you make. So this was minus 0.5. This one is about plus 1. This one is about plus 1, and that one's a scratch. So this was about 1.5 for the day, all things considered. And on a day when the market is down 1.5%, I don't mind bringing home a couple are. Felt pretty good. It felt correct. This is DBA. Now this is that agriculture note. So here I'm only interested in the long side on this one because it's kind of the inflation play. What that means was, once again, I don't get that play. Now this is I'm using a 4-cent risk box on that one. Even though the R10 is 3 cents, it just fell. So here's the PSAR flip, standard risk. Scratch. COTA 2. Nice little run up. Plus 2. So that's about a 0. Even though this was almost 1, I was hoping to see it hold here and then go. Hope is not a method, so I was willing to give it that extra wiggle room. Missed a COTA 2 entry twice. And what I've noticed just trading DBA in the past is that the first move, in the morning session is the tradable, and quite often that afternoon just kind of monkeys around. And I think that's because the ag agricultural product contracts are moving this price around, and when they close for the day, this just gets to kind of be noise. So I like to get paid on the morning move in DBA. This is Alcoa. So here's our gap. There's the close. Here's the open. Here's the OR3. That's the opening range 3. And our general idea on that is that if we see breakouts above that, we'd be interested in going long and hoping to capture that move to close the gap. And on breakdowns below, this acts almost like a collapsing dragon, and then we want to capture that move. So meanwhile, it's kind of in the this space in the middle here is just a yellow zone or indecision zone, almost like a giant noise box. It's just banging around inside there. So this is one where, with the combination of the gap down and then rolling over, it could not get above the OR3. It couldn't get up here. It starts to roll over, and I get a 1, 2, 3 entry. I go ahead and take that short, especially because that is the standard risk box to the top, to the high of the day. This moves a short distance and comes back, so I just scratch it. I'm wanting this thing to come running down, but it didn't, so we'll try again. I'm not going to get long on this one until I see it get above the OR3 or take out that PSAR dot. So that acts as a bit of an action buffer to keep me from chasing my tail. Now I get the what feels like a Kata 2, because we have the bottom of the RL10 and the PSAR flip, and we got the higher low on the RL10, and now it's crossed the PSAR. That PSAR has come down to here. Now I feel better here because it started to reverse. Instead of failing through here, it's actually showing some effort to get better. Now my thought is I want to see it get above the high of the day and then close the gap. And so I might put an extra target inside here. And then given the size of the risk box, which is this, I now have sort of like one play to the top of the day, maybe another play to the 50% retracement from the high of the day to yesterday's close. So there's another step and then a third step. So this feels like a potential 3R, 1, 2, 3, if it can get to the just to close the gap. And then if this fails further, well, it's going to be good. So that's some rapid framing with the standard risk box and standard trade architecture. Checker hold. So Kata 2. Minus a half. Now this is a stop and reverse for me because it did not follow through. And that's information. This is supposed to go. It did not go, and now that RL10 is rolling over, and it's testing that low of the day, and if it fails through here, that's all. You see how quickly that thing fails when support fails? That's why those are significant support levels for me. And this is this PSAR flip is a front run of that, and I'm using standard risk. Checker hold. That is standard work right there. It comes back into the station. I was hoping to see this thing just keep failing, but it stabilizes, and this is the time series that kicks me out, so I capture that little bit of gain, which is about half an hour. That's a stop and reverse for me because it had 25 minutes to fail and it did not. So maybe this is going to be that and try to and it's still the same frame now to the upside. And I'm using a standard risk box. And again, if this fails through the bottom of the RL10, I'm really only risking this box right here because I'm going to trigger right there. So I'm really only risking that much of the standard risk box because I want to be short below this. Check or hold. Basically scratch and reverse. Now there's a nice payoff. Oops, sorry about that. Crystal method. So here's the unit of risk, and that's about a 1, 2, 3. So that pays for, these two basically, this little gain and that little loss kind of scratches. This is a fractional loss, but now there's +3 that pays for all the sins. Now it's held for quite a while, and I'm willing to give that a try. And that gives a little fraction, and that's enough for the day. So that comes in around +3 for the day. That's sniper trades. Let's take a quick look at the traders. This is Constantine on the euro dollar. Here's the 5s. He's looking for the setting up with his 5-minute frame, and then this is the 1-minute execution. And he sees that this is failure to follow through. This is supposed to keep going 1, 2, 3. It's supposed to keep going. It does not. He gets the PSAR flip right here, identifies his risk box, gets paid the little recovery, and the dragon stops him out for 2.8. Very nicely done. Here's his gold US dollar pair on the 1 minute. He identifies that super long Z3P, probably a super pinch. There's a super pinch in there. And then he plays the breakdown, tight wrist box, and then recovers here when it hits the PSAR, 3R. So that's almost 6R on those two little instruments within his window. Now notice how he's really tuned into what move is available. The size of that move up and out of the congestion zone is the same size as the move down out of the congestion zone. So when it starts stalling, that's all there is. So take your 3R and be content. Nothing wrong with that. Tim's back from vacation. Now he's working the micro gold. 3-minute. Z3 pinch breakout. Gets paid a fraction. PSAR flip. Crushes it. Now notice how he gets to no lose. And then once the PSAR picks up, he then just tracks with the PSAR. Nails it. The RL10 double top also alerts him that that move is probably done. He gets that trade. That trade. This is pretty nice work. There wasn't much room in there. But he brings home basically 2R. That's nice work. It just got a little choppy in here. There wasn't much, but he gets basically all of the fat moves. So that's pretty good work. Welcome back. Woj with the, this is Devon and Tesla. Whoops. Excuse me. A little bit of price chop. He gets the piece of the move that was there. Great re-entry. This one, on that move that's that strong, I like using the edge of the dragon just to lock in instead of waiting for that extra. That allows you to keep, that'll cut your give back in half. After a really strong move like that, exaggerated, use the edge of the dragon. Boy, that's nice. He lets it move a wrist box off of the gap. Crushes it. Here was maybe a Kata 2 potential. 1.7. Not too shabby. Sorry. Tired. Long day today. Brings home another R in the Oz. A high, a lower high. That makes this a collapsing dragon. He starts trading it right here. So he waits for the breakdown and he nails it. This was a PSAR flip was available there. He waits for the confirmation of the Kata 2. I think you give back a little more. Again, I'd like to just see, after 8 bars in, get paid that little fraction. Missed entry, span of control, because he's working on the other two. So we want to find ways to leverage this. Here's your collapsing dragon. This rejects the PSAR and fails. Sets up that like a little triangle thing. At the base of that triangle, when it violates, that tells you that's the play. But really nice work, Woj. All right, so that was the traders from today. All right, let's find to the reports. Weekend report. Tomorrow is August 20th. So we are back into bearish quiet. So that's a slightly negative bias. This is at a critical state. If the long side's going to keep working and volatility diminishes, that should go up. But that could be one of these. That was a swing to the short side. When those things roll over, you got to be really sensitive to the start of the fall. ETF2 went from 100% exposed. Half of the indexes now fell back below their 4-month moving average, and that was mostly the globals. And we've already kind of talked through how to look at the RL. I'm going to make this is going to be the standard feature now, is that RLFF, the longer term 150-day look back, the 30-day look back, the 30-minute look back, and I've talked through those already. So now we'll take a look at the BMR portfolios real quick. So you can see, again, about half, and this is mostly the internationals. It's basically the U.S. plus Japan is above the 4-month moving average. The Russell had led the way up, is now given back. The conservative large caps offered the best protection. The internationals are just really vulnerable for short side exploitation. In the ETF 22, defensive plays of utilities. Energy is a cyclic, but it's in phase right now. Staples are a defensive play. So this is all defense working right now. This is why I love trading clean energy. I don't believe in it at all, but man, does it make wild swings, and those are tradable. Utilities and oil exploration, not bad. Energy on a bit of a run. Defensive staples, pretty good. In the Dow 30, not much to choose from here, but staples, Walmart, Coca-Cola. IBM has had a nice play in tech. Johnson & Johnson, Cisco. So Cisco and IBM were the kind of the oddballs out for tech that they'd been suffering longer term, but had some nice bounces. Let's go to the world market model. The U.S. is still above average. Growth has had a nice run, but it's almost getting long in the tooth. And then small caps have been better than the large and the medium. But Spider senses that that's ready to change after that nice run. That's what the RLFF was telling me. But the international's just getting smoked everywhere you look. Defense is still on the field, friends. Defense wins championships. Discretionary. Tech. Even the industrials having a nice little run here. Staples. That's the green and white. They were good and are now great. Possibility of exploiting new strengths. These are the new leaders. Volatile and liquid ETFs for shorter term trading. We want things that are in the green on ATR percentage. So they're very liquid and also volatile enough to trade short term. So energy, biotech, semis, oil exploration, Brazil, gold miners. You know, tech and small caps are close, and they are so liquid that that's actually probably pretty good, worth trading. They're tradable. Shift into the daily. We've seen all that. Today, it was not a large range day, so there's still quite a few dojis. A couple RL auto framers, Disney and 3M. 3M is showing signals all over the place, like a 5-day down, a triple screen, a 551W. So 3M is screaming, look at me. Other 5-day downs, Microsoft, so you must be interested in that one. And Tesla, 5 days down. So Ken H is going to frame those this weekend for sure. In the ETFs, handful of dojis, a significant number of auto framers now that there was that 1-day give back in the internationals. That's what you're seeing there. And then it was basically weakness ruled. So treasuries disappointed with a new 10-day low and 30-day low. Standard work in the auto framers. How's that spotlight work? Oh, that's not any good. I'm trying the new drawing tool. I like it when I see those two, Treasuries and Cliff, both trade very well intraday, and that's some amazing swing trade frames that make them attractive. U.S. Steel has pulled back to a 3.5 to 1 on a daily frame. I'm liking that. I'm liking all that. Even Tesla's pretty good with 1.8 to 1. This is a test back to the 10-day high. You know, the 10-day high in Tesla's at 944, and it closed today at 890. So that's $54 of potential gain from the current price. Good number of squeezes today. I like it when I see Treasuries, McDonald's, Microsoft, and XOP. Tesla, Diamonds, and XMO. That's some really good quality targets that have been outperforming, but which all were squeezed pretty tightly today. So they were not in a panic sell. Those would all be high priorities for framing. And I think that's everything we want to. Oh, we got to get the sniper. Sorry. So Sniper Land. We've still got two Godzillas in the S&P. Verizon and Newmont Mining. These are stealthy Godzillas. None in the tactical symbol set because of that nice run-up of the last 30 days. However, we do have quite a few popcorn frames. That's where they are extremely exaggerated to the upside on the weekly, daily, and tactical, but they've compressed nicely. These are just, again, they've had nice run-ups. They've had tight 5-day ranges and 1-day ranges and are ready to either break out for the next leg up or big failure down. The fence sitters are the ones that are in the middle around the 50-yard line and are in a tightly compressed range and are ready to break out to the highs or to the lows from that middle position. So that's what we mean by a fence sitter. All of the 5-day quiet ones are also very quiet on 1 day, with the exception of Watt, which was not much. And then the most volatile ones on the 5-day. So these were actual genuine movers today. The ones where they're also green on the 1 day. Those are the ones that are already moving. And you should be looking at them as because the momentum move is already in play. Tactical symbols and standard auto framer work. We're starting to see an equal balance now between summer and fall. All the ones in the fall are the ones where they've already rolled over, so there's a predominance of internationals in the big indexes. And these are typically the gaining indexes, you know, the short-term strength. And you see that phenomenon in the Dow, half and half between summer and fall. And we'll finish up with the NDX summary. Guys have been hanging in there good. That just shows you how much weakness has crept back in the short term. But there is some residual strength. Energy and the defensive plays in utilities. And then Coke, Merck, Devon Energy, McDonald's. That's where they have been relatively immune to that weakness. So the winners are going to win. Defensive plays. All right, that's everything I got for today. We'll get this published and processed, and we shall see you guys. Storytellers. Saturday morning storytellers tomorrow morning at 8:30. Trade framing with Ken H for swings tomorrow night. Euros Sunday morning for the Creativity 202 lesson of the week. We got the first round of results in from the Fletcher Creativity project at the college. The results are off the chart good. The effect of the Fletcher Creativity treatment on Army officers is even stronger than it was with the fourth graders and doctors. It is absolutely smashing the record for how good the creativity lessons are that he teaches. The Army's very, very excited about this. And we're on the cutting edge. We're the only organization that has that for traders. So if you're in the sound of my voice, I can't hype that thing too much, how good it is. You can ask the guys that are taking it. Good to see Chun Long. Are you back now, Chun, from your vacation? Hope so. We missed you last week, and looking forward to seeing you again. Good. The videos from the last couple weeks are really worthwhile. You're going to enjoy those. They're in the course, so you can catch up with us. Okay. All right, guys. That's everything we got. We'll take good care, and we shall see you tomorrow. I'm going to go watch The Seven Samurai, the greatest movie ever made. It's on, I think, Turner Classic Movies tonight. So I'm going to go get some popcorn and relax tonight. So take good care. We'll see you tomorrow.